Anything else? Any other questions? Chat feature. You're welcome to email me. You're welcome to call me. You're welcome to do it through the chat feature or unmute yourself and ask in class. And anything I can do to help, I'll be happy to do it to help. Our goal is to get you to pass. And it's really nice that you get good grades when you take the test, because I get graded on how well you do in the test. Now, we did have somebody the other night who missed the class that wasn't quite aware of our concept of skipping around. And we do skip around some. For the past few days, we've been going in order, but if somebody has a request for a chapter, I'm going to do that chapter. I'll do it along with other chapters, but from time to time, we will skip around. We want to be able to hit every chapter 3 times. And I know a couple of you guys have already been through this chapter we're going to do tonight, but that's okay because it's a big chapter, and that way you will solidify your knowledge. All right, so that's my speech for tonight. Let's get started. Chapter 14, Mortgages and Financing. So my first question, and it is a trick question, is where does a person get a mortgage? Where does a person get a mortgage? And the answer is, you get it in a stationery store, because all a mortgage is a piece of paper that hypothecates an asset as a security for a debt. So here from Staples' website is their mortgage kit. You can buy this. This allows you to create a mortgage. So if you're going to borrow money from somebody that's not a bank and they want you to secure that loan with a mortgage, you would just fill all this out and give that to that lender. Remember, the borrower is the mortgagor and the lender is the mortgagee. The borrower is the one who gives the mortgage. The lender is the one who gets the mortgage. So when you buy a house, what you are actually doing is you are getting a loan that's secured by a mortgage and evidenced by a promissory note. So people always say, I'm going to the bank to get a mortgage. Well, that means they've never taken my class, because they don't know what you're really doing is giving a mortgage to the bank in order to secure your note. This is just some information about this mortgage that you can download or buy, all the information that's going to be needed. And let's define a mortgage. What is a mortgage? A mortgage is a piece of paper, and we can say that it's a loan, but it's not really a loan. It's just a piece of paper that collateralizes real estate as security for a debt. And what I mean by that is Wells Fargo doesn't like, we know Wells Fargo doesn't like anybody. Remember, Wells Fargo cheated on creating all those phony accounts for everybody? They don't like you. So when they lend you money to buy a house, they want something from you that will make them whole again in case you default. And what that piece of paper is that can make them whole again in the event you default is the mortgage that you, the borrower, give to the bank. So the borrower enters into an agreement with the lender, usually a bank, wherein the borrower receives cash to pay for the house, makes payments over a set period of time until he pays back the lender in full. When he pays back the lender in full, the lender usually returns the mortgage to you, returns that original document that you signed 30 years ago. Usually they return that to you. A mortgage allows a buyer to get a loan that is secured by a mortgage, because Wells Fargo doesn't like you enough to lend you the money unless they can get something out of you if you don't pay them. So a mortgage allows a buyer to get a loan by securing the promissory note with the mortgage. So the promissory note is what allows the bank to sue you if you don't pay them. The mortgage is what allows the bank to take the house away from you if you don't pay them. So the loan is secured by a mortgage and it's evidenced by a promissory note. Your promissory note is the IOU. When you are financing your home and you're signing 1 million documents on the day of closing, you will sign a mortgage. And that mortgage is going to hypothecate or pledge your house as a security for a debt, and you will sign a promissory note. The promissory note allows the bank to sue you personally if you don't pay them back or if they have to foreclose. Again, the mortgage allows the lender to foreclose, and the promissory note is the IOU. It allows the borrower to be sued in the event of a foreclosure or a default allows them to be sued for a deficiency judgment that's issued by the court. Okay, so the promissory note allows the borrower to be sued. The mortgage allows the borrower to take the house away from you. Now, let's go back for a second to our mortgage document here that we can buy from Staples and all the things you need on your mortgage document. But in terms of the test, let's remember the mortgage needs to be in writing, needs to be in English. The parties that are signing the mortgage must have the capacity to contract. That means to sign a contract. It means 18, sane and sober, free of duress. Okay? There must be a legal description attached. So when you give the bank a mortgage, in New Jersey, you have to attach a legal description. And remember, the legal description is the meets and bounds description that's created by the surveyor. There must be a mortgaging clause. And again, it's as simple as the verb mortgages, or the verb hypothecates, or the verb pledges. You must have a mortgageable estate. So we can have a freehold estate or we can have a leasehold estate. You can mortgage a freehold estate. So the house you own where you have fee simple ownership, you can mortgage that. But you can't mortgage a leasehold estate. If you have a lease to a property, you can't use that as security for a debt because you don't own that property. So you must have a mortgageable estate. In the mortgage that you're giving the bank, there must be foreclosure provisions. And in New Jersey, we foreclose under the New Jersey Fair Letters Foreclosure Act, which is a judicial process. We are a judicial foreclosure state. That means you have to get in front of a judge. And in order to get in front of a judge, you have to file that lis, L-I-S, pendens, P-E-N-D-E-N-S. You have to file that lis pendens in order to get in front of the judge. The mortgage document has to have the signatures of the parties. And the most important signature is the signature of the borrower, because the borrower is giving permission for the bank to take their house away if they don't pay the bank. And then a mortgage has to have voluntary delivery and acceptance in the here and now. And for a mortgage to serve as a lien, this is really important. In order for a mortgage to serve as a lien, it must be recorded. And in order for it to be recorded, it must be accompanied with an acknowledgement. If you don't record that mortgage instrument, it is merely a contract, which means you would not be able to foreclose. You would only be able to sue. So it's very important that you record the mortgage. And in order to record it, it has to be accompanied with an acknowledgement. And that acknowledgement is going to verify, so to speak, the signature of the borrower, because the borrower is the one who is giving the ability to the bank to take their house back if they don't pay the bank. Okay, so this is all the things that have to be on the mortgage instrument. And if you record a mortgage, it serves as a lien. If you record it, it serves as a lien. Remember, a lien is a financial claim. And when you give that mortgage to the bank, so you're at your closing table, and your lawyer has you sign all these documents, and one of them is the mortgage. And then they nail that whole package of everything you signed. Wells Fargo usually processes this stuff in California. So they mail it out to California. Wells Fargo then mails it back to the county clerk in the town you bought the house. Let's say you bought it in New Brunswick. They're going to mail it back to Middlesex County. And the county clerk is going to time and date stamp it when they receive it. And the time and date stamp determines priority. So your first mortgage is the one that has the earliest time and date stamp. A second mortgage is one that has a later time and date stamp. And time and date establishes priority, and priority establishes who is going to get paid first in the event of a foreclosure. And we know from the other night that unpaid municipal taxes automatically jump to first position, even if they're not recorded. And we're going to see how the bank deals with that in a minute. Priority determines who gets paid first in a foreclosure. A senior lien is one that has a higher priority than a junior lien. Junior and senior is just a relative point of priority. The junior lien has been recorded at a later date than a senior lien. senior lien has been recorded at an earlier date than a junior lien. So one of the questions on the test is going to be, you have a first mortgage for $100,000 from 30 years ago, and now you get a second mortgage. So your first mortgage from 100 years ago is now down to like $20,000. And now you get a second mortgage for $300,000, which is the first mortgage. Well, even though the other one, the second one, is a much higher amount, the one that was recorded first is still the first mortgage. And again, the mortgage recorded in 10/1/1998 for $30,000, and a mortgage recorded on 4/8/2020 for $400,000 on the same house. Which is the first mortgage? Well, that's the one that's recorded first, the one that was recorded in 1998. Sometimes this second lien holder won't lend you the money unless they can be in first position. And if the person who's in first position, or the entity that's in first position, agrees to change positions, that's called a subordination. We're going to touch on that again later. That's called a subordination. Now, in the mortgage itself, there's clauses and covenants. Remember, covenants means promises. One of the first clauses and covenants is the acceleration clause. So your car has an accelerator. When you step on the accelerator in your car, it speeds up. So what the acceleration clause does is it speeds up the time you have to pay back the loan. If the lender accelerates your loan, instead of it being due in 30 years, it's all due today. They accelerate your loan. And there's a whole bunch of things that can cause acceleration of the loan, but there's two subparagraphs or subclauses that can also trigger acceleration. One is alienation, and that means if the ownership of the property changes hands, that accelerates the loan. And one is due on sale. If the property is sold, it accelerates the loan automatically. And there are loans that don't require you to pay off the loan when you sell it. And that would be an assumable loan, like a FHA loan or a VA loan. They're assumable, so they don't have alienation clauses. The next clause is a defeasance clause. The defeasance clause says that once you've made all your payments over 30 years, the bank no longer has any possible claim on your house. So what will happen is, after you finish paying off your mortgage, let's just say you stick it out for 30 years and you pay it off, the bank will mail you back your original mortgage that you signed. And where the lien was recorded by the county clerk at that time, they will stamp a red stamp next to it that says satisfied. And an officer of the lender, an officer of the bank, will sign that release of mortgage. And that will satisfy the mortgage. So that release creates the satisfaction of mortgage. Now it's your job to take that document to the county clerk and record it. Because recording that document closes your loan out as a public record. So we got a question. Is acceleration clause a 30-year conventional mostly? No, acceleration clauses are on almost all loans, except that FHA and VA loans do have the ability to not have to be paid off upon sale. So it's not acceleration clause is not a common, is only seen on a conventional. It's seen on almost everything. All right. The next clause is a subordination clause. We talked about that a minute ago. That's when the second lien holder, because of his risk factor, needs to be first, and the first lien holder, for whatever reason, might agree to that. And then you have to sign a subordination clause. And now you're in second position. So I sold a piece of land in South Amboy to the owners of Harbor Lights restaurant and bar and pizzeria. I sold them a piece of land that serves as their outdoor dining area now. And I sold it to the owner of Harbor Lights, and I held a mortgage. And Harbor Lights wanted to borrow a couple $100,000 from the bank, but the bank wouldn't be in second position. The bank would only lend him the money if he could be in first position. So he asked me if I would do a subordination agreement and swap positions. Not that great. It was not that big of an amount, so I did it. And I wish I hadn't done it because he hasn't made all the payments on a timely fashion. So I wish I had told him no. But unfortunately, I let him do it. So again, that's called a subordination. It means shifting the priority. I was in first position and I agreed to go to second so he could get his new loan, which would only lend him the money if they could be in first position. Again, I regret doing it. You also have a covenant to pay taxes. So on some loans, you don't have to escrow the taxes with the lender. On some loans, they let you pay the taxes yourself directly. And usually that means they're going to charge you a little bit extra interest. And the problem is, if you have the ability to pay the taxes yourself directly and you don't pay them, and you don't pay the taxes, unpaid municipal taxes automatically jump to first position. So your lender might have just lent you $400,000 to buy the house and they're in first position, but now you don't pay your taxes and maybe you owe the town $10,000 and that $10,000 is now going to be in first position because unpaid municipal taxes automatically jump to first position. Lenders now also have an insurance clause. They want you to keep your house in good repair. So insurance clause means you have to insure it and you have to make the mortgage holder beneficiary of the insurance policy up to the amount of the loan. So say you've got a house that's worth $500,000, you only owe the lender $300,000. Well, the lender only cares that you insure it up to the amount of their loan. And if your building were to burn down, then the lender would get the first proceeds from your insurance to pay them off. Also, mortgages have a good repair clause. You need to keep your house in good repair or they can accelerate the mortgage. Now, usually good repair doesn't mean you have to keep bushes trimmed and you have to paint the front of the house. But the house I was at today, that we met Paul Linares and John Papa at, the house I was at today hasn't been foreclosed yet. But we were all there because it needs to be boarded up and we need to repair what's wrong with it right now so it doesn't get any further damage. So the bank has the right to go in, change the locks, do the repairs in order to protect that asset, and they still haven't gotten to foreclosure yet. The reason, in this case, they haven't gotten to foreclosure yet is because there's a forbearance on foreclosure. Governor Murphy stopped all foreclosures in the state of New Jersey until sometime in the future because of Corona. All right, so those are all the covenants that you might have, and you might have many more. Those are just the main ones, and those are just the ones that you need to remember for the test. Now, we also have transfers of mortgages. If you've ever bought a house and you signed with Wells Fargo, and I'm picking on Wells Fargo tonight because they have lately a bad reputation. Transfer of mortgages is you sign your original mortgage documents with Wells Fargo. They do not want to know you for 30 years. So almost immediately, within a month or two of closing, they assign that loan to a third party. And it could be Freddie Mac, it could be Fannie Mae, it could be Ginnie Mae, but they are going to assign that loan to a third party and to a servicer because they don't want to collect payments from you for 30 years. So that's a transfer of mortgage. And when you're signing that gigantic stack of documents at your closing, one of the ones you're signing is that you give permission to the bank to assign your loan. Now, this stuff gets complicated. So bear with me slowly. This is mortgage takeover. When a loan does not have a due on sale clause or alienation clause, and somebody can take over the loan, there's a couple of different ways it can be done. The first one is a mortgage takeover. So in a mortgage takeover, our original buyer here buys a house, and he has a $100,000 loan. The house has a $120,000 value. And what he's going to do is he's going to let these new buyers take over his mortgage. They're going to still have a $100,000 loan because that's what he had, The rate is going to be the same. They have to pay him his $20,000 in equity, but on the mortgage takeover, the mortgage is still attached to the house and the note is still attached to the original borrower. So if these guys do bad and lose the house will be taken back via the mortgage, and the promissory note will sue this guy. You see, there's no promissory note over here that connects the new buyers to the loan. Only the original borrower is connected to the loan by his promissory note. So he'll get sued. That's a mortgage takeover. And there's a whole bunch of different ways this can work. Again, the original borrower here sells the house. These guys take it over, new buyer taking over. They default. The original borrower gets sued, and the bank takes the house back via the note. Now, when we have an assumption of a mortgage, and remember, all VA loans and all FHA loans are assumable. When we have an assumption of a loan, here's the original buyer. The original buyer gets a loan on the house, and it's an FHA loan. It's got, again, a $100,000 loan, and the house is worth $120,000. These new buyers, they want to assume the loan. So they're going to have to pay the original borrower his $20,000 in equity, and have to give him their $20,000 in equity. Now, the original borrower signed the mortgage and he signed the note. And in this assumption, as opposed to a mortgage takeover, in this assumption, the new buyers are also going to sign a note. And now, if a default were to happen, what happens is both parties get sued because both of them have signed notes. So if these new owners default, the original borrower gets sued and they get sued because there's notes still connecting both of them. And that's what's called assuming a mortgage with recourse. With recourse means there's still recourse against the original borrower. We can also assume a mortgage without recourse. And when we assume a mortgage without recourse, we have the same scenario. The new buyers are going to assume the loan. The new buyers are going to sign the note. They're signing a note. But the old borrower, the original borrower, who is now the seller, is going to have that note cut. And he has that note cut. The original borrower has that note cut by a novation. And it's the same thing as a novation in a contract. In a novation, we are substituting these guys in place of him on the note. Okay, and that's assumption of a mortgage without recourse. Now, nobody has heard of assuming a mortgage in quite a while. And nobody will hear of assuming a mortgage for quite a while. The reason is when you assume a mortgage, whatever this guy's original rate was, let's say it was 6%, when they assume it, they're going to get a 6% loan. But what we've been seeing is mortgage rates dropping. So if you were at 6%, you wouldn't want to assume his loan because you could refinance right now and get it, or get your purchase financing at 3%. So why would you assume his 6% loan? So again, we only see these things become useful tools when interest rates are going up. And they say that interest rates are going to be an all-time historic low over this late winter, early December to January to February. All-time low. We might see 2.5% 30-year fixed. That's incredible. And the interest rates that are charged on mortgages are closely reflected with bond yields or interest rates on treasury notes. So keep your eye on those things because we will probably have historic low interest rates. Now, 10 years from now, when you're going to assume an FHA loan, if you choose to do so, it will it will be written today at 3%, and 10 years from now, you might expect 7%. So if you could assume that loan, that would be wonderful, because then you wouldn't have to pay 7%, you'd only have to pay 3%. This is a very important tool when the market interest rates are going up. And since I've been in real estate, this is the lowest I've ever seen rates, but I have seen rates as high as 19% for purchases. So let's say we have crazy inflation 10 years from now. You'd be out there looking for FHA loans you could assume at 3%. And as real estate agents, excuse me, as real estate agents, when we close out loans, we have to say what kind of a loan it was. So 10 years from now, if you want to go back in the MLS and look at all the houses that closed with FHA loans, now you could approach those buyers and say, listen, I know you've never heard of assuming loans, but you know you might be able to get more for your house because a buyer might be able to assume your low interest rate loan. That's something to think about in the future. And again, what loans are assumable? Department of Veteran Affairs loans, USDA loans, and those are for Department of Agriculture rural loans, and Fannie Mae loans. All FHA loans are assumable. And there's other special loans that are assumable also. Here's the thing. You can get a conventional loan, and you can pay extra money, extra points, or a higher interest rate to make that loan assumable. It's just a matter of your negotiation with the lender. Okay, now we're going to look at this from another point of view. We're going to pretend we're a bank. So if you were a bank, how would you decide to whom you're going to lend money? So the first thing you do if you're a bank, because you don't want to be accused of any kind of discrimination, you don't want to be accused of favoring your friends or favoring people you know, you want to have a way to determine who is creditworthy that is outside of your opinion. And you want to be able to have a document that proves how creditworthy your borrowers are, so that you can sell that loan into the secondary market, because that is where the banks make all their money, by selling the loans into the secondary market. So the way we do that now is with a document that's called the Uniform Residential Loan Application. It's a 4-page application, and it asks borrowers all the same questions. It asks them their loan history, it asks them their income, it asks them their credit history, it asks them where they've lived and for how long. You know, the longer you've lived in the same places, the more eager they are to lend you money. Your educational history, the higher your education, the more they're willing to lend you more money. Your job history, the longer you've worked at the same job, the more they're willing to lend you, and other information. So that allows the lenders to decide if you're a good risk, but it also allows the secondary market to objectively grade borrowers and make sure they fit into their qualification segments. And all that information, all of the information that you give the bank when you fill out this document, all of that information creates these ratios, the front-end ratio and the back-end ratio. The front-end ratio is also called the housing ratio, and the back-end ratio is also called the debt ratio. And from the information that you give the lenders, they can create those ratios. And those ratios determine whether or not they feel you can afford your loan. So the front-end ratio, or the housing ratio, is principal, interest, taxes, and insurance divided by gross income. Principal, interest, taxes, and insurance, and these are real estate taxes. Principal, interest, real estate taxes, and insurance divided by gross income. And as in all formulas, they have to have consistent units. And so what I recommend to you is, when you're calculating these, you want to have the PITI by the month, and you want to have income by the month. But typically, the income is going to be given you by the year. So you're going to have to divide by 12 to get the income by the month. And that's one of the tricks on the test. You want to remember, you have to have consistent units. Both have to be by the month, or if you want to extrapolate it, both can be by the year, but there has to be consistent units. And that front end ratio kind of subjectifies your ability to repay the loan. And the amount that they typically want to see is a front end ratio of about 28%. And it varies from lender to lender and loan to loan, but typically they want to see about 28%. In the old days, the rule of thumb used to be that 1 week's pay should equal your monthly mortgage payment. 1 week's pay, and that almost comes out to 28% because there's a little bit more than 4 weeks in a month. So 4 weeks in a month would be 25%. So again, 1 week's pay would enable you to pay your mortgage. They want it to be 28%, and that's your front end ratio. So there's a question here. Let's get to the question. Thank you, Sue. PITI is the principal on the loan, the interest on the loan, the real estate taxes on the loan, and the insurance on the loan. I'm sorry, the insurance on your homeowner's insurance, and also the insurance if you're paying PMI or MIP. Okay, it's the insurances. That's the front end ratio. And again, that determines whether or not you can afford the house. Because you don't want to have, half of your income going to make the mortgage payment. Because these are gross incomes. And you're still going to have to pay taxes, and you're still going to have possibility of expenses like eating. So 28% is typically what they look for. Now there's also a back end ratio. The back end ratio is your principal, your interest on the loan, your taxes on your real estate taxes, your insurances, and again, that could be your homeowner's insurance, and it could be PMI and MIP, plus your consumer debt divided by your income. And typically, they want this number to be somewhere around 39 to 40%. Sometimes they stretch it, depending on your credit. And again, this is what holds many younger people from buying a house, because so many younger people have student loans, and student loans count in your consumer debt. And so your student loan may hold you back from getting a house. Right? Again, this is called the back end ratio or the debt ratio. And it's principal, interest, taxes, and insurance, plus your consumer debt divided by your income. And again, everything on consistent units. If you're going to do this one by the month, then you have to do this one by the month. Okay? And on the test, of course, they're not going to give you everything by the month. They're going to give you principal by the month. They're going to give you interest by the month. They're going to give you taxes by the quarter. And they're going to give you interest by the year. And they're going to give you income by the year. And your consumer debt, they're always going to give you by the month. But now you're going to have to convert everything to consistent units. You're going to convert everything to by the month in order to get the correct answer. And I'm going to warn you, every incorrect answer that you get is going to be one of the things that you didn't convert to the proper unit. In other words, you'll think you came up with the right answer because the number will come out right, but you forgot to divide the taxes, right? If taxes are by the quarter, that's 3 months. You would have had to divide the taxes by 3 to get the taxes by the month. So just make sure you have consistent units. And this needs to be 39% or 40%. Now on the test, they will give you a problem and they're going to give you a data set. They're going to tell you what the person's income is. They may tell you what the PITI is, or they may have you figure it out yourself. And you figure it out yourself by using a chart that's similar to the chart on page 488, which we're going to use later on anyway. So we're not going to look at it now, but we'll use a chart that's similar to that one that's on page 488 to figure out the principal and interest. And again, we'll get to that later because I have a math question on that. But they're going to give you a set of data for your front end ratio and a set of data that matches on your back end ratio, but they're going to put in the debt, and then they're going to give you 2 different rates. They're going to tell you that on the front end you need 29%, but on the back end you need 40%, and you need to qualify for both to get the loan. In real life, therefore on the test also, they're going to have, you're going to find out they qualify for the front end. You know, you'll get a front end ratio of 28, which means they qualify. But you'll do the back end, and the back end will be 45. That means they don't qualify because they have too much debt. And that's typically the question they're going to get on the test. They're not going to make it easy where both front end and back end qualify. Typically, they're going to have one qualify and the other not. Okay. Again, PITI is the principal payment on the loan. I is the interest. T is the real estate taxes. I is for income. And it's wrong. This should say I is for, actually, it should say for insurance. I'm so sorry about this. I is for insurance divided by income. Put on that. So this I here is incorrect. This is a typo. This should be interest. Listen, if you ever need a proofreader, don't even consider hiring me. I am not the best proofreader.
Insurance, isn't it? Insurance?
All right. You got it right on this one. PITI is principal payment, interest, real estate taxes, insurance, and debt is consumer debt. And there's some tricks to the consumer debt. There are some tricks to the consumer debt. If you have less than 10 payments left on your car, you don't count it. So maybe you have 13 payments left on your car, and they're going to count it, and it's going to keep you from getting qualified for the loan. Well, pay off 3 payments, get it down under 10 payments, and they don't count it. Or pay it off altogether. But there's some tricks to this, and a very good loan rep is important, because a very good loan rep can think fastly on his or her feet and fit your people into programs that otherwise it looks like they don't quite work. But there's a way to work on this. All right, so we're going to look at an example. We have a $300,000 loan at 4%, 30 years fixed. The principal is going to be $432 a month. The interest is going to be $1,000 a month. The taxes are going to be $1,000 a month. That would be $12,000 a year. That's a Highland Park kind of tax. Homeowners insurance is going to be $1,800 a year. That's $150 a month. And your income is $120,000, which is $10,000 a month. Now, we want to make everything by the month. I've given it all to you by the month. So when we look at this, our principal, our interest, our taxes, and insurance add up to $2,582 divided by our income, which is $10,000, means we have a 25%, 25.82% loan to value ratio. So bingo, we qualify for the loan. Bingo, we qualify for the loan. Principal is $432, our interest is $1,000, our taxes are $1,000, our insurance is $150. Now, while you're looking at this, notice in the beginning of a loan, your principal is not as big as your interest. In the beginning of a loan, your principal is smaller than your interest. Okay? As you get deeper and deeper into the loan, at some point, like around 23, 24 years, your principal starts to become larger than your interest. And in the very end, your principal payments are the larger part of your payment, and the interest is a small part. That's just the way fully amortized loans work. All right, so we qualified with a 25.82% in front end ratio. The next thing we want to look at is your FICO score. FICO is Fair, Isaac and Company, and your FICO score is your credit history. And it tells, on your credit history, it tells how long you've had loans and how you've repaid them. Okay, and we can see here that 30% of it is the amount you owed, 10% is new credit, 15% is length of credit history, 10% is what they call a credit mix, and 35% is payment history. And your FICO score can run from 350 to 850. And I ran into somebody yesterday who had an 850 score. So he had like a little halo over top of his head that followed him around. But the FICO score predicts your ability to pay loans, talks about your loan history. It looks at where you live, which is very unfair, but it does. It looks at your education level, and it looks at many other factors. And, you know, when you're a kid, your mom gives you a lecture about the most important thing is your reputation. Always guard your reputation. Well, your mom should also then pull you aside and say, well, not only is your reputation important, but you got to keep your FICO score up. because the better your FICO score, the lower interest rate you pay on things. Or if you have too low of a score, you can't even get a loan and you have to rent forever. So you need to keep your FICO score. Always be on time with payments. And a very important thing I tell everybody, because I've been asked to do it many times and I don't do it, never ever co-sign for a loan. Because if you co-sign for a loan, and that person messes up on the payments, it ruins your credit as much as it does theirs. So you do not want to ever co-sign a loan. You want to lend people money, lend them money. If you want to help them with a house, with some income or a monthly payment for a while, do that. Never, ever, ever co-sign. All right, now here's an example of what happens. If you have on FHA loans 580 or higher, you can make it 3.5% down payment. If your score is 579, that means 1 point less than 580, you got to put 10% down. You know, if you're buying a $300,000 house and your credit score is just crummy, you're going to have to put down $300,000 times 10%, $30,000. But if your credit is decent, you're going to have to put down about $11,000. It's easier to come up with $11,000 than it is to come up with $30,000. So again, very important that you keep your FICO score high. All right, so this is one way the lender decides if they want to take the risk by lending you money. Right? How your FICO score is, how your ratios are. The other way they determine whether or not they want to lend you money is the loan-to-value ratio. The loan-to-value ratio gives them an idea of what happens in the worst case scenario. What happens if they have to foreclose? Are they going to get made whole again? And the definition of loan-to-value ratio, the definition is the sales price or the appraised value as the denominator and the loan amount as the numerator. So we have the loan amount up top and we have the sales price or the appraised value, whichever is lower on the bottom. Very important because the bank always does everything in their favor. The bank always does everything in their favor. So on loan-to-value ratio, we've got a $100,000 loan on a $100,000 house. Sales price is $120,000. The appraised value is $115,000. So we know our loan. We know our loan is $120,000. We know our loan is $100,000. And now, which one of these two are we going to use? We've got to use the lower one. So we have 100 divided by 115. Remember this, because this is happening now. Prices are going up very fast right now. And when an appraiser does appraisals, he uses closed comps. So his closed comps from a month ago or 2 months ago or 3 months ago reflect Corona lockdown. And now the prices have gone crazy. So if people are paying more than full price for houses. So when they pay more for full price than a house, and it's still going to appraise because of the older comps from Corona time, we're going to have a lot of houses that are having an appraised value less than the sales price. We're going to have a lot of houses that have appraised value less than the sales price. And your loan-to-value ratio is defined as the loan amount divided by whichever of the sales price or appraised value is lower. And again, in real life today, because of the way the market is going up so fast, it is easy to conceive of a house selling for $120,000 but only appraising for $115,000 because 3 months ago, similar houses to it sold for $115,000. So this is, you're going to be aware of this all the time. Now, how can you solve this? Well, it might mean that the buyer has to come up with $5,000 extra down payment. It might mean that you're going to ask the seller to reduce the price. And in a couple of deals I've seen recently where people have paid more than full price, in attorney review, the attorney for the buyer is saying if it doesn't appraise, then the buyer doesn't have to buy it. And they also could choose to just pay the appraised value. And that's really not fair to the seller, because if the seller chose your offer based on you being the highest price and it doesn't appraise, why should they have to suffer that? You paid a premium to be top of the list. So again, this is something that comes up now in this kind of market very, very frequently. Somebody told me a story today about a house that listed for $800,000 and it sold for $1 million cash in 2 days. So if they do the loan to value ratio on that, they're going to have to use the sales price is going to be much higher than the appraised value. Typically, conventional loans require an 80% loan to value ratio, or you have to pay PMI. And PMI stands for private mortgage insurance. I think there's 5 PMI companies left after the crash in 2008. And what those PMI companies do is you make insurance payments on a monthly basis to the PMI company. You're making insurance payments monthly to the PMI company. Then if you get foreclosed, the PMI company pays any losses the lender has to the lender. The PMI doesn't do you, the borrower, any good. It just pays the lender. So somebody asked if it's a good time to put a house on the market, and I do not have a crystal ball, but I can say, as my friend Alan Greenspan said once, there is irrational exuberance in the market. So I would say it might be a good time to put a house on the market now. And there's also downside risk. Remember, if you don't put it on the market now, there's downside risk, because the downside risk is what happens if Corona gets worse. And what we're seeing now is in the southern states, it's getting really bad. And what happens if this winter we get a second wave and the southern states haven't even cured their problems from the beginning, and the economy has to shut down for a long period of time? You might see prices retract a little. So again, with the irrational exuberance that's going on now, you might want to think twice. And again, putting a house on the market doesn't mean you have to accept an offer. You might put it on the house with your dream price to see if you get it. And if you get it, great. And if you don't, you take it off the market and see what happens next. All right. So 80% loan to value ratio, you don't have to pay PMI. If it's higher than 80%, you're going to pay PMI. And again, you, the borrower, don't benefit if a PMI payment has to be made out as a benefit, insurance benefit. That benefit is paid to the lender. And that's what makes the lender okay with lending you money. Let's see, we got another question. Okay. We're going to go back to our example. So let's use this one. And let me read your question again, so I just make sure I answer it exactly what you need to answer. Can you repeat the example of when someone has to pay more down payment because the appraised value is lower than the sales price? Okay. So we're buying a house, and whatever we're putting down, we're going to end up resulting in a $100,000 loan. Whatever we put down, we're going to end up with a $100,000 loan for rate. And we agreed to pay $120 for the house. And it's quite possible that if you agreed to pay $120 for a house, when the appraiser comes out and does the appraisals, he uses 3 closed comps and 3 active comps. He has to use comps that are within the 6-month period. So 6 months ago, we had the height of the lockdown, and prices dropped really quickly at the height of the lockdown. So it's very, very likely that it's going to appraise at 115. So you paid 120, it's going to appraise at 115, and you're going to get a $100,000 loan. And let's just say this loan to value ratio doesn't cut it. Let's say the loan to value ratio you need to cut it is 100 divided by 120, which would be the 100,000 divided by the $120,000 sales price. So 100 divided by 120 is 0.83. So if it appraised, let's say you need a 0.83 loan to value ratio to qualify for the loan. You need this loan to value ratio to qualify for the loan. And so now they do the loan to value ratio, but it appraised at only 115. That means they have to use the 115 in the formula. And when they use the 115 in the formula, your loan to value ratio comes out at this number, which is not acceptable because you need to have a 0.83. So how do you get this number to a 0.83? Well, one way is that instead of borrowing 100, you bring $95,000 extra to closing and you only borrow 95,000. And now we're going to have 95,000 divided by 115. And that's going to give us, a 0.82 loan to value ratio. And that 0.82 qualifies because we only need a 0.83. So this is not an uncommon thing in this kind of a market. This is going to be a headache for real estate agents because you're going to have to watch when people bid more than the full price. I'll give you a couple of tricks you can use. And I'm not supposed to say tricks, I'm supposed to say techniques. You want to make sure, let's say on this particular house, let's say on this house, the sales price was 120 and the asking price was 115 on this house. You might want to change the listing as the listing agent to reflect a list price of 121,000. Here's the trick that you use. In other words, sales price was 120. We were originally only listed at 115, but people bid it up to 120. Now you want to kind of make sure it appraises. So what you do is you go back into the MLS and you raise the price to 121,000. Now, that's going to show something bad because it's going to show a price increase in the MLS and on Zillow. Then you go back in again the next day and you reduce the price to 120,000. Now it shows a price reduction to 120,000. It doesn't show that you had a price increase, and that list price of 120,000 makes it easier for the appraiser to appraise it at 120, right? Because originally we said the list price was 115, and sometimes the appraisers are affected by the original list price. So that's just a technique people use sometimes to make sure it appraises. All right. If that's not a good explanation, we'll try again. Now, the next question is it possible for the buyer to switch lenders after attorney review? So let's not talk about attorney review. Let's even go a step in the other direction. When you write out your contract for purchase on a house, you are going to stipulate what type of a loan you're going to use. And that's going to have an effect on the seller deciding whether they're going to accept your loan or someone else's. Because if loans came in and one loan was FHA and another loan was conventional and they were for the same price, I would suggest to my seller they take the conventional because there is a higher probability of a loan closing with a conventional loan. There is a lower probability of a loan closing with FHA loan. And one of the problems is mortgage reps typically get paid more on an FHA loan. So mortgage reps are always pushing the buyers to switch in the middle of the transaction. So you are not allowed to just switch. You are not allowed to say, all right, I said I was going to do conventional and I want to do FHA now. You're not allowed to just arbitrarily do that. But you can ask if you can do it. And when you ask if you can do it, you're going to need an addendum to the contract that substitutes the fact that you're going to now go FHA rather than conventional. And there's a couple other issues with FHA. FHA is very strict on peeling and flaking paint because especially if a house was built prior to 1978, we saw that the other night on one of the questions, they're very strict on peeling and flaking paint. So if you have a house and you switch it to FHA and it's got peeling and flaking paint, that's all going to have to be remediated before closing. So the answer is you could switch, but you should get permission to switch because otherwise you're not performing up to what you said you were going to do on the contract. On my bank-owned properties on Fannie Mae, if a buyer switches from conventional to FHA, they make them do all new contracts. And again, it happens a lot because loan reps get paid more for Fannie Mae loans, for FHA loans than they do for conventional. So sometimes they try to push their people to switch. Okay. Again, conventional, if you have a loan to value ratio of 80% or less, no PMI. And that would be 20% down. If you put 20% down, no PMI. The next thing we want to talk about is points. Points are, the definition of them is prepaid interest. Each point is 1% of the loan amount. Each point is 1% of the loan amount. So if you have a $150,000 loan and you're going to pay 2 points, that's $3,000. And what paying points to the lender does, it increases the yield on the loan. So it makes the lender more money. It increases the yield on the loan. And there's a magic rule. And I don't know why the math works on this, but it's a magic rule. It's called the rule of 8. For each 8 points that you pay, or each 8 points that a lender charges you, it changes the yield on the loan by 1%. And there's sometimes questions on the test. So if you're getting a 3% loan, and you really want a 2.5% loan, but you qualify for a 3% loan, so you're trying to reduce it by 0.5%. 8 points reduces it by 1%. So if you were to pay 4 points, which would be 4% of the loan amount, the lender would reduce the interest rate from 3.5 to 4. Okay? Now, why would you do that? Why would you pay 4 points to reduce your interest rate from 3.5 to 4? Because remember, 4 points is 4% of the loan amount. Well, the reason you do it is, first of all, you may not qualify. Your income might not be high enough to qualify at 3%. So you might only qualify at 2.5%. And the second reason to do it is if you know you're going to stay in your house for a long time, once you pass the 8th year, and again, it's called the rule of 8s, it's just like a mathematical coincidence that it works this way. Once you reach your 8th year, now you're saving money overall. Now, the amount that you save by only paying a 2.5% loan is going to be, you're going to save that money and you're going to pay off that 4 points you had to pay. So again, that's why people do that. So can I record my class? You're welcome to record the class, but I do record it and post it. I did post a couple today, but you're welcome to record it. By the way, thank you for asking. All right, again, rule of 8 says if you've got a 4% loan and you're paying 2 points, that's going to give a 4.25% yield to the lender. And if you're paying 2 points, they'll probably reduce your interest rate by 2/8, which is a quarter, which means you would have a 3.75 interest rate. So the borrower might pay points to reduce his interest rate. And again, he might do it to qualify for the loan. And again, he might do it because he knows he's staying in the house for 30 years. So, you know, again, just a mathematical calculation. By the way, people used to stay in their homes an average of 8 years. Another thing, coincidence on that rules of 8. Just prior to the 2008 banking lockup, just prior to that, that had gone down to 7 years. People were moving more often. Now they're saying that it's going to go up. People are going to stay in their houses for longer because of all the damage to the economy and to people's credit that was done by the Corona lockdown. All these people who have chosen forbearance on their mortgage payments or have chosen to put the payments on the back end, it's going to affect all their credits and their ability to refinance at some later date, which means if they go to buy a new house, they might have trouble buying a new house. So they're going to end up staying in their current house longer. So you're going to have people now living in their houses for more than 8 years. That means it might be a good idea to pay the points and reduce the rates. In some countries in Europe, like Germany, houses stay forever with the buyer. Houses stay in families own houses multi-generationally. It's here in the United States that houses move very quickly. And I sold a house to two gentlemen from Germany, and they were so tickled because it is so difficult to buy a house in Germany. And here they were, like 23 years old, buying a house in the U.S. All right, now we're going to talk about some terms. One of them is usury. Usury is charging more than legal limits on interest. When President Obama was president, he passed a law to try to make these payday loans illegal. We don't have them in New Jersey, but usury is charging more than the legal interest on it, legal rates on interest. In New Jersey, the legal rate is about 30%, 39% in some instances. Some of these payday loans were at 1,600%. Imputed interest is charging a lower limit than normal on a loan. One of the things that would have come out with Bernie Sanders, if he would have kept running for president, he hadn't dropped out, is he took a very large loan from his campaign fund to buy a beach house. He talks about rich people, but I think he's pretty rich. And he bought a second house, a beach house. He took the money out of his campaign fund. Now, you can't take campaign money out of your campaign fund to use on yourself, but you can borrow it. So he borrowed the money at zero interest. And since he borrowed the money at zero interest, and interest rates are 4%, the IRS treats it as if it's income. So the $40,000 a year that he would have had, if Bernie Sanders would have had to pay an income, an interest, the $40,000 a year that he would have had to pay an interest if he had charged himself an interest rate, now gets sent to him as income on a special version of a 1099. That's imputed interest. This comes into play a lot out in Silicon Valley, because at one point I was thinking of moving out to Silicon Valley, and the house that I own in Colts Neck that's worth 600 and change $1,000 is $3 million out in Silicon Valley. So the only way I could have afforded to move out there was to get a loan from the people that were hiring me and have no interest. And that's what some of the big firms are doing. You give no interest loans, but then you have to pay income tax on the imputed interest. All right. We've got a couple of questions here that kind of move us through a little bit of the stuff we went over. So let's just look at these for a second. I'll give you 5 minutes to answer the 5 questions, and then we'll go over 5 minutes to answer the 5 questions. Let's see if I missed any questions. All right, let's roll. Okay, a certified statement showing the outstanding balance due on a mortgage is an estoppel certificate. Now, where's that important? When you're assuming a mortgage, you want to have a certificate that says how much of a loan you're assuming. So that is a estoppel certificate. By the way, from the other night's class, where do we see covenants of season? We see covenants of season in all deeds, except what kind of a deed? What kind of a deed has no covenant of season? What kind?
Quick deed.
Good girl. Whoever said quitclaim deed, good girl. All right. Number two, in the event of a foreclosure, if the most you can lose is your equity, in other words, you're not going to get sued, you just bought a house subject to the existing mortgage. Who's going to get sued if that house gets foreclosed? If you bought it subject to the existing mortgage, who is going to get sued? If the most you can lose is your equity, means you're not going to get sued for a deficiency judgment. Who is going to get sued?
The original
Good.
owner.
Very good. Whoever said that, excellent. The original borrower is going to get sued. Oslowski bought Vitello's property by assuming the existing mortgage and paying $30,000 in cash. 3 years later, Oslowski defaulted, and the mortgagee, that's the lender, foreclosed on the mortgage. Which of the following statements is true? So,
C.
C.
C. Good job. Good job. The clause that makes a mortgage unassumable is the alienation clause. It means if it changes hands, alienation means to change hands, it's unassumable. So if there's no due on sale clause or no alienation clause, it's assumable. If there is an alienation clause or a due on sale clause, it is unassumable. It's unassumable. A deed in lieu of foreclosure conveys a title to whom? And it is the mortgagee, it's the lender. What a deed in lieu of foreclosure is, if you're on the path to being foreclosed, and the foreclosure attorneys for the bank charge a fortune, and they're going to charge all of that to you, and eventually it's all going to be pumped into your deficiency judgment, and you want to end it quickly so that you don't have that much money pumped into the deficiency judgment by the attorneys, you prepare a deed and you give the deed back to the lender instead of making them foreclose. The only problem is this deed in lieu of foreclosure in New Jersey creates title problems for the lender. So typically, under most circumstances, New Jersey lenders will not accept a deed in lieu of foreclosure. Other states will, but typically in New Jersey, it creates some title problems, so they don't. All right, a couple more questions. We'll let you work on those. See, we got a question popping up here. Okay. Good job. All right, let's get going. Number 6, charging more than the legal limit is known as usury, right? You know, lending money at higher than the allowed rate is called usury. It's illegal. That's what loan sharks do. That's what Tony Soprano did. They lent money out. They charge 20%. They charge 20% a week. So if you borrow money from the mafia, it's 20% a week. Number 7, a mortgager is the person who holds the mortgage. No, the mortgager is the one who gives the mortgage. The OR means gives. So the mortgagor is the borrower. The borrower gives the mortgage to the lender. So the mortgagor gives the mortgage. I think somebody had that right. So let's double check. Yeah, you got it right. Good job. If the amount realized as a share sale as part of a mortgage foreclosure is more than the amount of indebtedness and expenses, this money belongs to the mortgagor. That's the original borrower. But I will tell you that in order for the mortgagor to get that money, he has to make an application to the sheriff's office. If he doesn't make the application to the sheriff's office, he doesn't get it. That seems highly unfair. But the sheriff's department is not in the business of finding the people to whom money is owed. So again, the excess belongs to the mortgagor, the borrower, the person who lost their house, but they have to make an application. Number 9, Elle has just made the final payment on her mortgage. There will still be a lien on the property until she records a satisfaction of mortgage. And every time I tell the same story, hopefully it helps you remember things. 1952, my father bought his house for $9,000. In 1982, he paid it off. 30 years later, the bank mailed him back his notice of satisfaction. And like people used to do in those days, he held a mortgage burning party, because when they returned the mortgage, that meant they no longer had a claim on his house. And what happened was he didn't record the satisfaction. So he burned that document, thinking, oh, that's what I should do because that's what everybody does. And then a couple years later, when my youngest brother went to borrow money to go to college and my father was going to get a home equity loan, the bank said, you never paid off your original mortgage because he hadn't recorded his satisfaction of mortgage. Now, that was something that he could contact the bank and he could get proof and he could solve this. It took a couple of months, but it caused everybody stress. And there's a rule in the family, there's an Archie bunker where Archie has a mortgage burning party. So again, when your mortgage comes back to you after living in that same house for 30 years, you're going to take it down to the county clerk's office and you're going to record your satisfaction of mortgage. That closes it out on record so it doesn't show on your credit. It shows if it's paid off on your credit. A person who assumes an existing mortgage loan, who assumes it, is, oops, a question here. Excuse me for a second. One answer. The answers are good too. 7A. So are we talking about which one being C? 10, okay, I'm sorry. Person who assumes an existing mortgage. If you're assuming the mortgage, you are usually going to be personally responsible for paying the balance. The person who assumes it is usually going to be responsible for paying the balance, right? The original borrower is going to be released from liability if there's a novation, and that only happens, but not always. So the person who assumes the mortgage is personally responsible for paying the principal balance, right? And if it was assumed with recourse, he would be personally responsible, but equally so would be the original borrower. If it was assumed without recourse, the new person who assumed the loan would be responsible all by himself. Okay, this is confusing. I know it takes a couple of times of going through it to actually be able to get it down pat. Not easy, and it's sometimes counterintuitive. All right, buyer wishes to buy a home. The purchase price is $200,000. The buyer will put down 10%. The lender requires 2 points. How much are his points going to be? So think about the math on this one, and we have a hint on this one. Remember, the points are only on loan amount. So this requires you to think. If he's buying a house for $200,000 and he's putting down 10%, what is the loan amount? He's buying a house for $200,000 and he's putting down 10%. What's the loan amount? Very typical question on the test.
That 180,000?
That's right. So his loan is going to be 180,000, and we're going to pay 2 points. What's 2 points on 180,000?
$3,600.
3,600. All right, and you better believe there's going to be a $4,000 answer, because if you use the purchase price and multiplied it by 2%, you're going to come out with $4,000. So you've got to remember that points are on the loan amount. Points are on the loan amount. Buyer wishes to purchase a home. Purchase price is $200,000. He's going to put down 10%. The lender requires 2 points. The house appraised at $180,000. What's the loan to value ratio? So this is a loan to value ratio question. By the way, the hint on this one, okay, I'll do that in a second, Walter. Oh, I'm sorry. Asta, I'll do that in a second. In this question, one of the hints here is that the points have nothing to do with it. This has nothing to do with it. So all we're looking for is loan to value ratio. So again, how much is the loan? Purchase price 210% down. How much is the loan?
Well, it's 180,000.
It's 180,000. And on loan to value ratio, we divide by the sales price or the appraised value, whichever is lower, right?
Right.
And what's the appraised value? 180,000. Therefore, we divide by 180,000. Sales price is 200,000. Loan amount's 180,000. Appraised value is 180,000. 180 by 180 is 100% loan to value ratio. So if you were doing this loan with an FHA loan, you couldn't do it. FHA loan only lends up to 96.5% loan to value ratio. On this property, what kind of a loan could you use? What loan's 100%?
VA loan. A VA loan.
Good job. A VA loan loans up to 100% loan to value. So again, somebody asked me for a better definition of points. Points are 1% of the loan amount. And the definition of points is prepaid interest, right? Normally you're paying your interest a little bit at a time. What points do is it pays some of the money up front. So points are prepaid interest. It pays some of the interest up front. Each 1%, each 1 point is 1% of the loan amount. And again, we have that magic rule of 8, where if you're going to get a 4% loan and you pay 8 points, it reduces your rate to 3%. But you just paid 8% of the loan. Now, why would somebody do that? Well, maybe so they can qualify for the loan. And also, if they stay in the house longer than 8 years, it becomes a financial benefit to have paid the 1% lower interest rate. But the definition of a point is 1% of the loan amount. What's another name for a point? Prepaid interest. And that interest affects the yield to the lender. We have to look at things from the bank's point of view. We have to look at things on how the bank feels about things. All right, a loan pays $3,000 a year in interest. The principal is $200,000. What is the rate of interest? And again, we're going to look at our magic thing here. We're going to put earnings up here. That's how much interest we're being paid. We're going to put a dividing sign here. We're going to put our principal here and our rate of interest here. And if we're looking for the rate, which is R, we would put our finger over that R so we couldn't see it anymore. And then we would do what the circle told us. And the circle is telling us if we're looking for the rate, to divide earnings by principal. But again, we have to make sure we have everything in consistent units because interest rates are, so many percents per year. And we do have years here, so we're good. So if we take our earnings, and our earnings are $3,000, and then we divide it by 200,000, that's going to give us our interest rate. Okay? Typical question on the test. So again, $3,000, that's how much our earnings are, divided by the principal, which is 200,000. That gives us a 1.5% interest rate. Prepayment penalties are a function of a loan where if you pay the loan off early, you have to pay extra money. In New Jersey, we cannot have prepayment penalties on loans, purchase money loans that you use to purchase a house. But you could have a prepayment penalty on a refinance. You refinance your house and then you hit the lottery and you pay it all off. You might have to pay an extra fee to pay it all off early. That's prepayment penalties. But in New Jersey, we cannot have prepayment penalties on loans that were used to purchase a house. We talked about usury being charging higher than the legal rate for interest. Imputed interest is, again, not charging enough interest. And then they send us a 1099 for income. Now we want to look at adjustable rate mortgages, an ARM, an ARM, an adjustable rate mortgage. On a 30-year fixed loan, on a 30-year fixed, fully amortized loan, your interest and principal payments are going to be the same for the full length of the loan. And let's say you get to be one of the lucky ones next month and you get a 2.75% interest rate. That interest rate is going to be on that loan for the whole 30 years. And if interest rates skyrocket in 10 years, when China and the United States get into a real big conflict and interest rates skyrocket, the bank took the risk of the interest rate going up because your interest rate is going to stay the same for 30 years. So an adjustable rate mortgage shifts the risk of fluctuations in interest rate from the lender to the borrower. So if you get an adjustable rate loan and interest rates shoot up, you, the borrower, are the ones who have to pay the extra money. All right? So the buyer takes on the risk of interest rate fluctuations. Typically, when you get an adjustable rate loan, the amount of interest that you're going to pay on an adjustable rate loan is an index plus a margin, and that gives you your rate. Typical margins are one-year treasuries, federal cost of funds, prime interest rate, the London interbank offering rate. Those are all indexes plus some margin. And the margin is what you negotiate with the bank. The margin could be 1%, could be 2%. So if you had a margin of 1% and your index was the federal cost of fund, your rate would be 1.224 plus 1%, so it would be 2.224. Now that's great for you today, but if that federal cost of funds number goes way up, well, now your interest rate would go way up. Okay? So again, the buyer takes on the risk of interest rate fluctuations. How does this help you? Well, it helps you because in the beginning of your loan, they might give you a loan that has a very low interest rate for the first 3 years. Like a teaser rate, they call it. It might be 1% for the first 3 years. And then for the next 27 years, it adjusts based on your margin plus your index. So for the next 27 years, it can go up and up and up, depending if we have inflation and interest rates going up. However, you qualify for your loan under that 3%. So it makes it easy for you to qualify for your loan because your interest payments on 3% are lower than interest rates on a higher number. And for the first 3 years, I'm sorry, not 3%, your interest rate on 1% is a very low number. And so for the first 3 years, you'll only have 1% interest, but then it'll go up every year depending on your index plus your margin. right? And it doesn't have to be 327. It can be 228. It could be every 5 years it goes up. Again, the risk of an interest rate loan, the risk of an adjustable rate loan, the risk of an adjustable rate loan is that interest rates go up, you have to pay more money. Now, adjustable rate loans can have rate caps and payment caps. And what that means is if you have an adjustable rate loan and you're paying $500 a month now, and it has a payment cap that says the most you could have to pay would be $600 a month. However, you have a margin and an index where inflation shot up and interest rates really shot up, and now you were supposed to be paying $700 a month based on your margin and your index, but your cap says you're only going to pay $600. The bank doesn't give you that extra $100, the difference between 7 and 6, $100. The bank doesn't give you that $100 for free. What the bank does is they tack that $100 onto the end of your loan, onto your principal. They tack this onto your principal. So what happens is your principal grows in a negative direction. Every month you owe more than the month before. Every month you owe more than the month before. Let's see what this question is here. We're still confused on points. So we'll try again one more time. So on rate caps and payment caps, you could have negative amortization, and that is a potential risk. During the 2005 market, we had a lot of loans with negative amortization. So we're going to go back again to get to points. Points. You're going to get a loan. You're going to get a loan. And the lender said, we're going to give you a 4% loan. But in order for us to give a 4% loan, because we don't make enough money on that 4% loan, we want you to give us some interest in advance. We want you to pay us some interest in advance. And points are prepaid interest. You're giving the lender interest, money for interest in advance. And we have a definition of what a point is. Each 1 point is 1% of the loan amount. So if your loan is $200,000 and you're paying 1 point, that 1 point is going to cost you $2,000. You're going to pay $2,000 when you originate the loan extra. You're going to hand your lender $2,000, and he's going to give you that 4% loan that otherwise he would not have given you because he was not making enough money. Okay? So that's the simple definition of points. Each point is 1% of the loan amount. What those points are prepaid interest, and those points add to the yield that the lender is making. And don't forget, the lender is taking your loan and selling it on the secondary market. And how many points it has and how much interest it pays is how much the secondary market pays the primary lender for the loan. So all of the things that you don't see behind the scenes that the bank does, it affects how much the bank makes. So again, a point is 1% of the loan amount. And what a point is, it's extra interest that you're paying in advance to make bankers rich. It's a very simplified version. If I haven't done a good job explaining it yet, I'll try again later. But, sometimes it takes a while to sink in. Now, we're going to define loans by different segments. First, we're going to define conventional loans. A conventional loan is a loan that is neither government insured or government guaranteed. So a conventional loan is not government insured and it's not government guaranteed. Okay? A conventional loan is not government insured or government guaranteed. A loan that is government insured is an FHA loan. Government insures FHA loan. You pay the insurance premium, the government maintains the pool of insurance. FHA loan is government insured. And a VA loan, Veterans Administration loan, is government guaranteed. The first $89,000 of losses if the house gets foreclosed, the Veterans Administration pays to the lender. So how does that help you? The way it helps you is it allows you to buy a house, if you're a veteran, for 0% down. That's very risky for the bank. There's a very high probability that if you are buying a loan with 0% down, there's a very high probability you're going to default. And the bank isn't going to lend you the money, except the VA says, listen, if that borrower defaults, we have to foreclose. If the borrower defaults and the bank has to foreclose, the VA is going to pay up to $89,000 to the bank. So the VA is going to pay $89,000 to the bank. And when you think about it for a second, an FHA insured loan in Middlesex County loans up to $700,000 and change. A VA loan, I think, loans up to $380,000, because it would be hard to lose $89,000 on a $380,000 house. Somebody bought a house today and it got foreclosed tomorrow. It's not going to lose $89,000. So that means the bank is going to get made whole again. Okay? On a FHA loan, the bank will lend up to 96.5% loan to value ratio, 96.5%. But on a government insured loan, a FHA loan, they're going to want you to pay MIP, which is mortgage insurance premiums. A conventional loan will lend you money, but if your loan to value ratio is higher than 80%, they're going to want you to pay PMI. PMI is private mortgage insurance. MIP is mortgage insurance premiums that go to FHA. PMI payments are private mortgage insurance premiums that go to the 5 PMI companies that are still around. In government guaranteed loans, the VA will make an $89,000 payment to the lender in the event the borrower defaults. None of these things help the borrower in any way, except it makes the banks willing to lend you money. Canada does not have as big of a system of these government insured or guaranteed loans. And typically in Canada, everybody has to put down 30%, which means it's a little harder to buy a house. Imagine if everybody had to put down 30% every time they bought a house. So a conventional loan, the definition is one that's neither insured nor guaranteed. A government insured loan is an FHA loan. A government guaranteed loan is a VA loan. And we learned a little earlier that government insured loans, FHA loans, and government guaranteed loans are both assumable. Now, where do you get an FHA loan from? You get it from a bank who's approved by the FHA. Where do you get a VA loan from? You get it from a bank that's approved by the VA. Do you get a lower interest rate on an FHA loan? No. You get the opportunity to have a lower down payment. You get a lower interest rate on a government guaranteed loan, a VA loan? No. You get an opportunity to make a lower down payment. These were invented to let people with less money buy a house. Lower down payments, less money. All right, we're going to talk about loans as we define them by how they work. The first one is a fully amortized loan. A fully amortized loan has the root word morta in it. In Italian, morta means death. And what dies on the fully amortized loan? The principal. We kill off the principal over the period of the loan. At the end of a fully amortized loan, you don't owe anything. You've killed off the principal. One of the significant characteristics of a fully amortized fixed loan is that your payment for principal and interest will be the same every month for all 360 months if you have a 30-year loan. A straight loan is interest only. If you have a straight loan, you just pay interest, and at the end of the term, you owe all the principal. If you borrow money from the mafia, you're going to pay 20%. This is in a legal rate. You're going to pay 20% a week. So if you borrow $100 from the mafia, At the end of the week, you're going to pay back 20%, but you still owe the 100. That's a straight loan or an interest-only loan. You're only paying interest. Now, other people besides the mafia do this kind of a loan, but it's a clear example with the mafia. That's a straight loan or a term loan. We also have graduated payment loans. These loans are sometimes known as doctor loans because when you first have your white coat ceremony and you're first become a doctor and now you're going to serve your residency, they don't pay you anything. But you want a fancy house because you're a doctor, and doctors have to have fancy houses. So on your front end ratio and your back end ratio, they're going to give you a very low interest rate to make it easy to qualify. And the characteristic of a graduated payment loan, as opposed to an adjustable rate loan, is all of the upward adjustments are predetermined. So maybe on the first year, it'll be 1%. After you finish your residency and you get a real job and you're making a lot of money, it'll be 3%, and then it'll level off at 4%. Sometimes they call these step loans because they go up in predetermined steps. So sometimes they call them step loans. And the reason they call them doctor's loans is they were invented so doctors can get a really nice house in the very beginning when they're not making a lot of money. Another loan is a reverse annuity loan. So a reverse annuity loan looks at senior citizens. And what do senior citizens have? They have a house that maybe has a lot of equity in it. What does a senior citizen not have? Big income, because they're retired. So how can they qualify for a loan on that front-end housing ratio if their income is zero? You know, because if you divide by zero, it's undefined, right? So how can they get a loan if their income is zero? Well, a reverse annuity loan does not take into consideration their credit. It does not take into consideration their income. All it looks at is their equity. How much equity do you have in the house? And it will lend you a percentage of your equity. It will lend you, depending on how old you are. If this guy is 80 years old, it will lend him a larger percentage of his equity than it would lend me at 67 years old. It would lend him a larger percentage of his equity because he's going to die sooner. So what they do is they look at an actuarial table. They decide how long you have to live. They figure out when your equity is going to run out, and they lend you that amount of money. Or they give it to you in an annualized or a payment as if it's annuity, an annuitized payment. And so little by little, every month, the senior citizen is dumping equity out of his house. Every month, he's living on that equity, and he owes more and more. So its principal balance goes higher every month. That's why it's called the reverse annuity loan. And I think you have to be 62 and a half, if I remember, to get one of these. They are FHA insured. So if this guy's actuarial table says that because, you know, he's lived to be this age, they said he was going to live to be 88 years old. And so they're going to lend him so much money that by the time he's 88, he will have zero equity left in the house by the time he's 88, and he lives to be 110. That means he's going to owe a lot more on the loan than the house is worth. But this is an FHA product, so it's insured. So FHA insurance then will make up that difference and say, in the end, he owes $100,000, and say in the end his house is only worth $70,000 because he lived so long, he used up so much of his equity. The difference between $170,000 and that $30,000, the FHA insurance will make the lender whole again. Now, when you have one of these reverse annuity mortgages, you have to live in the house. If for some reason you leave the house, it accelerates the loan and you have to pay it all off at once. If you're married and your spouse is not 62 and a half and you die, your spouse has got to sell the house. If you go to the hospital for more than 6 months, you have to sell the house. And the people who hate these kind of loans, the people who hate reverse annuity loans are the kids of the homeowner, because every year that their dad lives, the equity in the house goes down and they inherit less money. This happens a lot in Highland Park because you might have a person in Highland Park You know, the average Social Security payment is $1,700 a month. So if you're getting $1,700 a month in Highland Park and your taxes are $2,000 a month in Highland Park, just for your taxes, you've got no money left after you get your Social Security check. So how are you going to live? Well, you might get a reverse annuity mortgage so that you have a large sum of cash, or an annuity payment every month that gives you income. But every month you're going to owe more on the loan than the month before. That's a reverse annuity. Biweekly mortgage was invented by Amboy Savings Bank in Perth Amboy. You know, in the old days, people used to get paid once a month. There's some rules in New Jersey that say you can't pay people once a month. Usually people get paid every 2 weeks, or maybe even every week. When my father was working, my father used to get paid on the 15th and the 30th of every month. So he would get paid on the 15th and the 30th. And when we would get to like the, you know, nearing the end of the month, it was the 28th or the 29th of the month, you know, we would be eating peanut butter sandwiches because there was not much money left. So what they discovered, though, was people tend to spend all the money they have every week. That's what everybody does. So they said, here's what we do. Instead of making a mortgage payment a month, how about you make a half of a mortgage payment every 2 weeks? How about you make a half of a mortgage payment every 2 weeks? And if you make a half of a mortgage payment every 2 weeks, you end up making 13 payments a year instead of 12. And by doing that, you pay your loan off 7 years sooner. And that saves you a tremendous amount of interest. And, you know, it's my belief that interest is evil. And many religions believe interest is evil. And all major religions at some time or other have made the payment of interest or the receiving of interest against their religious rules. All major religions. So, again, you'll be surprised at how much money you save by paying your loan off 7 years sooner. And you get used to making that half a loan payment every 2 weeks if you get paid every week, because you know exactly how much to budget for your loan payment. Next kind is a purchase money mortgage. A purchase money mortgage is defined as the loan that's used to purchase a home. So that's the broad definition. Any loan you get to purchase your home is a purchase money mortgage. And remember, we can't have prepayment penalties on purchase money mortgages. But another definition of a purchase money mortgage is when the seller is holding a mortgage. When the seller is going to sell you his house and he's going to have you make payments to him. That's a seller-held mortgage. One of the things to remember on the test is a seller-held mortgage on the closing statement. This is counterintuitive, but a seller-held mortgage on the closing statement is a debit to the seller and a credit to the buyer. That's going to be on the test, guaranteed. A seller-held mortgage is a debit to the seller and a credit to the buyer. And on the math question on the test, it's going to give you some numbers of prepaid taxes. That what's the amount of the credit or debit? What's the amount of credit or debit for the purchase money mortgage? And you can eliminate two of the answers right away, because you know a seller-held mortgage has to be a debit to the seller and a credit to the buyer. Construction loans. When you go to get a construction loan, what the bank does, when you're going to get a construction loan, and I built a couple of houses, it's really fun, and it's also very risky. When you go to get a construction loan, you're going to bring your plans to the bank. You're going to bring your plan to the bank. And the bank is going to appraise your house based on the plan. So you bring the plan to the bank, and the bank says, okay, when that house is built, it's $500,000. And the bank is going to not lend you $500,000. That would be crazy. Instead, they're going to give you a line of credit for usually 80%. So they're going to give you a line of credit for $400,000. But that's 80% of 5. They are not going to give you that money, because if they gave you that $400,000 and you took off, what do they have to foreclose? Just an empty lot. So they're not going to give you the money. So what happens in a construction loan is you're going to dig your foundation. You're going to dig your foundation on your construction loan under the house here. And when it's done, you're going to have the bank come out to look at it and make sure it's done. And then the bank is going to give you the money for digging your foundation. They're going to lend you $10,000 out of your $400,000 line of credit. So your first month's payment is going to be based on $10,000. So now the next month you're going to do your framing. And a framing on this size house is going to cost $50,000 or more. So the next month you're going to have the bank come out and they're going to see that you finished the framing and they're going to give you $50,000. So now the second month's payment is going to be based on $60,000, which is 10 plus 50. The third month you're going to put on your roof and that's going to cost you $10,000. Bank's going to come out, inspect the roof. They're going to give you the money. So your third month's payment is going to have $10,000 more on there. Your third month's payment is going to be on $70,000. And you keep doing that until you've done all of the elements of construction, and you've used up the $400,000. Now, if you think about it for a second, that leaves you your $100,000 profit because the bank assessed the house or appraised the house at $400,000. So when you sell it, you should make your $400,000. But every time, keep in mind, the bank sends their inspector out to the house to see what work you've done. They're typically going to charge you $750. So if you have them come out for the foundation, and then come out again for the framing, and then come out again for the roofing, and then come out again for the rough electric, and have them come out again for the rough plumbing, and have them come out again for the finished electric, have them come out again for the finished plumbing, you can see that those 750s add up and take away your profits. So when you're building a house, and you've got that $400,000 line of credit, you want to have good relationships with your subcontractors, so you might get them to wait to be paid, so you only take one draw at a time. Instead of taking one little tiny draw for each thing, you take one draw at a time. That's how a construction loan works. In the first house I built, when I went to the bank, I was building a 3,000 square foot all brick house, and they gave me a construction loan for $180,000. Could you imagine building a 3,000 square foot all brick house for $180,000? Those were the days. But they also gave me a chart showing me what percentage of my total loan they would give me for each part of the work I completed. Made it really easy for me then to know how much I should be spending on each aspect, each part of the construction process. The next kind of a loan is a bridge loan. And you may be seeing bridge loans start to get a little bit more popular again. In a bridge loan, you've got your original house and you see that prices are going up and you want a bigger house because you want to work at home and you don't have room to work at home anymore. But you haven't sold your little house yet. So you have a first mortgage on your little house for when you purchased it. You have your first mortgage from when you purchased it. And now your bridge loan is going to be a second mortgage on your old house. The lien is going to be on your old house. And you're going to use that loan you got on your old house. You're going to use that bridge loan, that second mortgage, as the down payment on your new house. And then you're going to get a new first mortgage on your new house. So when you do one of these bridge loans, you're still paying your first mortgage on your old house. You're now paying your new second mortgage on your old house. And you're now paying a new first mortgage on your new house. So a bridge loan can get very, very expensive. And you know, today you might not have to do it because your old house might sell really fast. But sometimes it doesn't. Sometimes your new house is kind of slipping out of your grasp, and so you might take that risk. Another kind of a loan is a blanket mortgage. And a blanket mortgage has a release clause. In a blanket mortgage, it's usually for a builder who's building 4 homes, and they're all in various stages of construction. As he finishes this home and he wants to sell it, there's only one lien, and that's this blanket here, on all 4 properties. He's finished this home and he wants to sell it. And in order to sell it, he has to get the lien released. So a blanket mortgage has a release clause. That allows this home to come out from under the lien and be sold. And let's say this guy was shooting for a 200K number on each of these homes. Typically in a blanket mortgage, when the bank would release the lien and let him take this one out to sell it, the bank would not allow him to have the whole 200. Usually the bank is going to allow him to have 80% of it. So that means you're going to sell that house for 200, you're going to give the bank 160, and you're going to have 40. Because the bank, again, doesn't want to give you all the money, because then that increases their risk. So for purposes of the test, a blanket mortgage is a mortgage that has a release clause. The next kind of a mortgage is a package mortgage. You're looking to buy a farm, and you're thinking about what's the loan-to-value ratio. The loan-to-value ratio is the loan divided by the sales price or appraised value, whichever is lower, right? But he's got 100 head of cattle, which are worth $30,000. So where does that fit into this calculation? In a package mortgage includes both the real property and the personal property, because cows are personal property and the barn is real property. So a package mortgage includes both real property and personal property. Sometimes on the test they use this example. Sometimes on the test they say a person bought a condominium that was furnished with very expensive furniture, and the bank wants to use the furniture and the condominium in the loan-to-value ratio. What kind of a loan should they get? They should get a package loan, because the condo is real property, the furniture is personal property, and a package mortgage uses real and personal in the loan-to-value ratio. That's a package mortgage. The next kind of a mortgage is an open-end mortgage. That's like your credit card. We don't have too many open-end mortgages. You might have an open-end line of credit on your second mortgage, but an open-end mortgage is you get $100,000 as you borrow it. You borrow all $100,000, now you have nothing. But as soon as you pay back the $100,000, you have it available again. That's like your credit cards. As you pay your credit card off, you have available balance. A wraparound mortgage is another type of financing where the original borrower sells his house to the new borrower. So the original borrower sells, in a wraparound mortgage, the original borrower has a house, and he owes $100,000 on it, and the payments are $500 a month. And he's the original borrower. He's going to sell the house to this new borrower. But now they are not going to create a new note to the bank. Instead, this borrower is going to sign a note to him. And this borrower is going to have ownership of the house. And as this borrower makes the payments that are $500 a month, he's going to make the payments to the original borrower. And he's going to depend on the original borrower to make the payments to the bank. Now think about it, that's risky for him, because what if the original borrower isn't sending the payments into the bank? The house is going to be foreclosed for non-payment. This borrower will lose his house and he'll lose his equity. Okay? Now another thing that happens with this is the original borrower did a good job of getting a loan, so his loan is only costing him $500 a month. He might decide to upcharge the new borrower. And instead of charging him $500 a month, charge him $600 a month. If he upcharges the new borrower, that's called arbitrage. Arbitrage, from the German word Arbeit, which means to work. He's making that loan work for him by earning an extra $100 a month by upcharging him. So when you have a wraparound mortgage, you can have arbitrage. And remember, a wraparound mortgage is especially risky to the second purchaser, because he doesn't know for sure that the guy who sold him the house, who was the original borrower, he doesn't know for sure he's sending those payments into the bank. The next kind of a specialized loan is a shared appreciation loan. If you are Sharia compliant, you can neither pay nor receive interest. So how can you buy a house? Well, you buy it with a shared appreciation loan. So if you're buying a house with a shared appreciation loan, we're buying a house with our shared appreciation loan, and let's say we're buying a $100,000 house, and you're going to put down $33,000, and the bank is going to lend you $65,000. well, let's say 67,000. Okay, so the bank has lent you 67,000, no interest. Now, if the house goes up in value, let's say it doubles in value, doubles to 200,000, your equity doubles, it goes up to 66,000, and the bank's equity doubles too. It goes up with 67,000 is 134,000. Bank's equity goes up to 134,000. So you share in the appreciation. That's a shared appreciation mortgage. And that allows you to borrow the money without having to pay interest. That's a shared appreciation. Now the bank calculates how much appreciation they gain if prices go up based on what the prevailing interest rate should have been, but it's just that you're not actually paying interest. So you can stay Sharia compliant. And there's a number, including Wells Fargo, of Sharia compliant lenders out there. The next thing is a buy down. And we had talked about points before, and a buy down is something that uses points as a tool. So this guy is a builder, and he sold this house for 100, this house for 100, this house for 100, but now he's having trouble selling this house, and the buyers will only pay 95,000. But if he takes 95,000 for this one, and this one, this one, and this one might sell for 95. So the builder doesn't want to take 95. So what the builder says to the buyer, let me pay points. I'm going to pay points. I'm going to pay, you're getting $95,000. I'm going to ask you to pay the 100,000. Let's say you're paying 100%, so that's your loan. Makes my math easy. You're going to get a loan for 100,000. You're going to pay me 100,000. But you really only want to pay me 95. But here's what I'm going to do. I'm going to pay 8 points to the lender. And if I pay 8 points to the lender, instead of you having a 4% loan, I'm buying down the rate. The lender will only charge you 3%. And your payments will end up being lower than if you paid $95,000 with your 4% mortgage, or whether you pay $100,000 with your 3%, your mortgage payments will be lower at the $100,000 at 3%. So that's a way the builder supports the prices on his subsequent homes. Otherwise, he'd have to sell them all for 95. That's a buy down. Now, again, I want to emphasize lenders do not like us. Lenders want to get rid of us as soon as possible. The primary market is the banks themselves and other sources of financing themselves. The secondary market is entities like Fannie Mac, Ginnie Mac, Fannie Mae, this should be M-A-C, M-A-E, Fannie Mae, Ginnie Mac, or Freddie Mac, Fannie Mae, Ginnie Mae, and Freddie Mac. Prior to 2008, the ones that started with G were owned by the government. So Ginnie Mae was owned by the government. And the ones that started with F were owned by shareholders. So G for government and SF for shareholders. But in 2008, the federal government put all of these under government conservatorship. And there's been some move to remove them from government conservatorship, to put the Fannie and Freddie back into private hands. You can buy shares of stock in Fannie and Freddie, but there's been some pushback by the administration and by some people in Congress on both sides and both parties. So again, that hasn't been accomplished. We're still under government conservatorship. And what these entities do is they buy loans in the secondary market. So you're a borrower, and you want to borrow money, you're going to go to the bank. The bank only has so much money. So if the bank is an approved lender, you're going to go to the bank, you're going to fill out one of those uniform residential loan applications. The bank is going to lend you the money. The bank is going to take, because when you borrow that money, you give the bank a mortgage and a note. The bank already has locked up the secondary market that will buy that mortgage and that note. And so now the bank is going to send them your uniform residential loan application and all the terms and conditions of your loan. It's going to be processed as the mortgage closes, after the mortgage closes. And then the lender is going to send pools of the mortgages and notes to the investors, to Fannie Mae or to Freddie Mac. Fannie Mae or Freddie Mac are going to package them They're going to package all of them into mortgage-backed securities and sell them to investors. And then every month, you're the borrower. Every month, you're going to make payments to the servicer. Remember, we said your loan was going to be assigned to a third party. Every month, you're going to make payments to the servicer. And the investors who buy those mortgage-backed securities are going to get varying rates of return on them. Now, a bad thing happened in 2008. In 2008, no investors would buy those mortgage-backed securities. So the credit market locked up. And the way they solved that credit market being locked up in 2008 was quantitative easing 1 and 2, and the Treasury bought all of the mortgage-backed securities. Recently, the mortgage-backed securities are still being purchased by the Treasury, but not 100% of them. The Treasury has been trying to get away from purchasing them, but it's creating some difficulty in the financial market. And I read an article the other day that again makes me worried about worldwide economics. Saudi Arabia purchased all the mortgage-backed securities that had secured that were securitized for their loans on their residential properties in Saudi Arabia. Why did they do that? I'm not smart enough to know, but whenever a government makes a gigantic move like that, they must be thinking of hedging their bets somehow. So again, we talked about that uniform residential loan application. That's why it's so important that you qualify for all the lending standards, not for the bank, because the bank doesn't care if you're a good borrower or not. The bank just cares that they can qualify your loan to go into these packages so they can get rid of you. Okay? That's the FHA process in securitization. We also can get money from REITs. There's all kinds of REITs, real estate investment trusts, are listed on these in the Wall Street Journal. Remember, REITs have to have 100 members at least. REITs have to have 75% of their income come from passive sources, and REITs have to distribute 90% of their profits every year. But a lot of real estate is purchased by REITs. We also have the New Jersey Housing and Mortgage Finance Authority as a source of money. New Jersey Housing and Mortgage Finance Agency is dedicated to increasing the availability of and accessibility of safe, decent, and affordable housing for families in New Jersey, and they left out of lower income. You're going to see Joe Biden talking a lot about he is trying to change laws all throughout the country to stop people from zoning against poor people. So, you know, I live in Colts Neck. Colts Neck has a 10-acre minimum lot right now restriction. So to buy a 10-acre minimum lot in Colts Neck is going to cost you $1 million for the lot. So there's not going to be any poor people living in Colts Neck. And Joe Biden says that's not fair, that poor people should be living everywhere in the country. He's going to try to get those, what he claims are discriminatory zoning rules made illegal all throughout the country. Something to watch for, something to listen to his speeches about. Now you'll have an idea what he's talking about. The next thing is a very bad type of financing arrangement. It's called a land contract or a contract for deed. And remember, we talked about redlining. Redlining is when a lender draws a red line around a neighborhood, used to be around African American and Asian neighborhoods, and they would not do FHA loans. FHA loans are government insured loans. So the FHA would not insure loans in African American and Asian neighborhoods. And when they would not insure those loans in African American neighborhoods, how did African Americans or Asians have to buy houses? They would do it with a land contract. The difference between a land contract and normal financing is that in a land contract, the seller keeps legal title. So the seller keeps the legal title, and the buyer, the vendee, only gets equitable title. And what happens is, why it's so bad and so risky is if you have a contract for deed or a land contract, and you're making 360 payments, and you miss payment number 340, so way deep into the amortization schedule, you miss payment 340, you lose your equity and you lose the house. On a normal deal, if it gets foreclosed, you only lose the house. If you have any equity, remember we have an equity of redemption that you can make an application for. And there is a really great article about the case for redemptions that was published in the Atlantic magazine. Infante Coates wrote the article. Very long article, but if you can Google it, the case for reparations, and read it, you will see people during this Black Lives Matter period of time, politicians suggesting we need to relook at reparations. And they might have a point, because the way non-African American and non-Asian families built wealth from the 1940s till now, up until this craziness that happens with finance, was through housing, was through owning homes, and built a lot of multi-generational wealth. But because of these land contracts or contracts for deed, African Americans and Asians for a period of time were not allowed to do it. There's another type of financing called a sale-leaseback. Now, we might not have got to this chapter for some people, but we might have got for others. Remember, a tax consequence of owning real property, or a benefit, is that on income-producing property, you get to depreciate it over 39 years, which means each year of 39, you get to take 1/39 of the value of the property and use it against income. You get to use it against income, so it keeps your income down. But at the end of 39 years, when you fully depreciated something, you lose the ability to have that benefit. So one of the ways that you can now make something work in your favor, if you have fully depreciated the property, is you sell it. And you sell it to someone who is going to rent it back to you. So the seller becomes the tenant and the buyer becomes the landlord. What's the purpose of doing this? If you have fully depreciated this building for tax purposes, if you now become a tenant, your rent is deductible. And let's say you've got an old factory like this, and this happened to all the car dealers after 2008. They knew that they were not going to build cars with people anymore. They knew they were going to build cars with robots. So they needed a lot of money to buy the robots. And they have owned their buildings for 100 years. So they've been fully depreciated. So they did sale leasebacks. That got them a lot of cash. And that cash allowed them to build their robots so they could get rid of workers. And now they have the ability to deduct their rent payments and not worry about the fact that they no longer had a depreciation allowance because they've owned them for more than 39 years. So what's the reason to do a sale leaseback? Change your tax position and increase liquidity and put money in your pocket. Some illegal acts that lenders do, violations of the Equal Credit Opportunity Act. That's the law that says you can't require people to tell you about their child support or alimony. It also says that you cannot ask about a woman's birth control in order to make her qualify for a loan. Illegal acts by lenders are redlining, where you draw a red line. There's a case, red lines around African-American neighborhoods, and they would not lend money. And they would not lend money in those African-American neighborhoods. And last, violations of the Home Mortgage Disclosure Act. And there's another typo, that should be Act. Violations of the Home Mortgage Disclosure Act. That's the act that made those deed restrictions, like Mr. Levitt of Levitt Builders put on houses in Levittown, New York, Levittown, New Jersey, and Levittown, Pennsylvania. He put deed restrictions that said Caucasians and Gentiles only. So only white Christians could buy his property. Only white Christians could buy his property via deed restriction. This Home Mortgage Disclosure Act made that illegal. So, you know, I've been around a long time. All of this stuff happened within my lifetime. So I know that there was vast levels of discrimination by the government, which is horrible, by the government against minorities in terms of being able to buy houses. So when you hear these talks of reparations, and people say, well, how could you make reparations to somebody for something that happened in 1861, 1862, hundreds of years ago? The real answer is, maybe we should make reparations for things that happened in 1945 or 1950 or 1960 or 1964, because that's when these things were all made illegal. Those are illegal acts by lenders. Now we have illegal acts by borrowers, mortgage fraud. That's over assessing a property or lying about the value or the down payment, another typo. Falsifying employment income. You go to Staples and you buy a stack of W-2s and you write your own W-2s out and pretend that's what you are earning. Occupancy fraud. You get a better rate if you're going to own or occupy a property than its investment. So you lie that you're going to own or occupy it when really it's an investment. That's occupancy fraud. Employment fraud. You create a phony website. You say it's a business. You tell the lender you've been working at that business for 2 years, but you really haven't. Employment fraud. Identity theft. Someday, punch into the computer how many people in this country have a similar name to yours. Every one of those people has the ability to steal your identity very easily because they already have a government-issued ID that has your name on it. Appraisal fraud is when you get appraisers to give appraisals that are not consistent with the true value of the house. Undisclosed kickbacks, or when you give a kickback to a lender for allowing a loan to happen, or you're a lender and you're going to sell your loans into the secondary market, and you get the secondary market to overlook some of the deficiencies in the loan by giving them a kickback. Again, illegal. Undisclosed second mortgages. That's when you have a second mortgage on the house, but you don't tell the lender, so that the lender does not have a true idea of the loan to value ratio. And then flipping is not necessarily an illegal act. That's why I have all those asterisks there. But flipping is an illegal act if it's done in conjunction with the illegal appraisals or illegal ownership. Predatory lending is illegal. Equity stripping is a form of predatory lending. There's a movie called Tin Man with Danny DeVito, Kevin Dreyfuss, Richard Dreyfuss, and it's a movie about guys who are selling aluminum siding to old people who have no mortgages. And they tell them they can have the aluminum siding for free with no payments for a number of years, but they put on very high interest rates that are accumulating in the background. And then using a mechanics lien, they foreclose on the property. Unjustified risk pricing, big investigation in Pennsylvania. Again, I'm picking on Wells Fargo. Wells Fargo was charging African Americans just recently a higher interest rate than white applicants with the same credit. That's unjustified risk pricing. Single premium credit insurance. Well, you can have PMI or MIP. Those are types of mortgage insurance, but they can't charge you a single premium type of insurance that says you're going to make all the payments. And then short-term loans with disproportionately high fees. We talked about those earlier for usury. Those are the payday loans or the car title loans. And those loans, even though they were made, President Obama tried to make them illegal. President Trump has made them legal again. All right, so now we're getting down to the end of the night. I know it's been a long night and we've really done a lot of work tonight. So we've got 4 more questions to answer. So I'll give you a minute and you'll do the 4 more questions. 4 more questions to answer, and then we're going to call it a night. All right, last 4 questions of the night. In terms of the lowest down payment possible, VA loan, right? VA loan can be 0 down. Let's see, we got a question here. One is B. No, the VA loan. FHA loan can be 3.5% down. A VA loan can be 0% down. And on a VA loan with 0% down, there is no PMI or MIP. There's no mortgage insurance required on a VA loan. This is a benefit to honorably discharged veterans. Number two, when FHA approves a loan. So when the FHA approves a loan, we know that they do not loan the money. The bank loans the money. They don't set the interest rate. Market rates are what set the interest rate. Does not determine how the points will be dispersed, but it does determine the required down payment based on the appraised value because of the loan to value ratio. You have to have at least 96.5% loan to value ratio. Number three, which of the following mortgages would most likely require PMI? And we don't have PMI on FHA, so that's wrong. We don't have PMI on VA, so that's wrong. We don't have
Conventional.
I'm sorry?
Conventional loan.
Conventional loan has PMI. Don't forget, a conventional loan means one that's neither insured nor guaranteed by the U.S. government. And the P in PMI means private, means no connection to the U.S. government. Number four, federal income tax regulations allow a homeowner to reduce his or her taxable income amounts paid for real estate taxes. And we know, so the answer is C. And we know that President Trump in his tax bill said that the most you're allowed to reduce it is $10,000 for state and local taxes. And that's okay for Georgia or for South Carolina, but that really hurt us here in New Jersey, where many people pay more than $10,000 in taxes, or New York or Connecticut. So again, I don't care who anybody votes for, but I want you to watch out when they're talking about what they're trying to sell you, and that's both parties. Sometimes what they do, both parties, isn't really good for you.
For the masses, yes.
For the masses. And I don't care who you vote for. I'm just telling you, watch what they're saying, because you could influence what they're saying. And I think we have another question here. Let's find another question. No PMI on FHA. No, you have MIP. You have MIP on FHA. You have PMI on conventional. You have MIP on FHA and PMI on conventional. So conventional loan is one that has no connection to the federal government. The P in PMI stands for private. So this was a tough class tonight, a little longer than normal, but that's okay. I'll try to get the recording up as soon as I can. The longer the class is, the longer it takes YouTube to process it. But we'll work on it. And I'm going to try to have, between now and Tuesday, a couple more special extra classes. So keep your eyes and ears open. And I'm working on sending you a lot more study guide materials. So keep your eyes and ears open for that. All right. Any questions? Anything else? And it's good night. I'll talk to you guys later on. Thank you very much for hanging in there tonight.
Thanks,
Good
Bruce.
night.
Thank you.
Thank you very much.